In the vast, cacophonous arena of the financial markets, there is a language spoken by the 99%. It is a language of spectacle, of soaring narratives, of breathless hype. It is the language of top-line revenue growth. It asks one question, over and over, with the frantic energy of a gambler at the roulette wheel. How fast is it growing? Is it doubling? Tripling? Is it the next big thing? This question echoes from the trading floors of Wall Street to the venture capital hubs of Silicon Valley. It's a siren song, promising untold riches, and it has lured countless investors and entrepreneurs onto the rocks of financial ruin. Because this language, for all its excitement, omits the one word that truly matters. It ignores the single most important metric in the creation of long-term wealth. That word is cash. Warren Buffett, the Oracle of Omaha, speaks a different language. It is a quiet, deliberate, and devastatingly effective dialect. It is the language of economic reality. His central question is not how fast a business is growing, but how much cash it produces. A great business, in his mind, is not a rocket ship burning fuel to reach escape velocity. A great business is a spring, an artesian well, gushing cash, year after year, with little effort. And the true genius, the act that separates generational wealth from fleeting speculation, lies in what happens next. How that cash, the retained earnings of the business, is intelligently reinvested at high rates of return, creating a virtuous, unstoppable cycle of compounding. This is the final promise of any great enterprise. It is the secret engine that hums beneath the surface, far from the roar of the crowd, building fortunes for those patient enough to listen. Today, we deconstruct that engine. We will learn to separate the vanity of growth from the sanity of cash. We will learn to identify the gushers, to understand the machinery of compounding, and to adopt the mindset that has made Warren Buffett one of the wealthiest and most respected investors in human history. This is not a lesson in stock tips. It is a fundamental shift in perspective, a journey into the heart of what makes a business truly valuable, and it begins with the most basic, most powerful, and most overlooked substance in the financial universe: cold, hard cash. The first pillar of this entire philosophy is understanding the absolute, non-negotiable supremacy of cash flow. It is about learning to distinguish between the numbers a company reports and the cash it actually earns. This is the difference between accounting fiction and economic reality, and for an intelligent investor, it is the difference between success and failure. The income statement can be a masterpiece of creative writing, but the cash flow statement is a work of history. It tells you what actually happened to the money. To truly grasp this, we must travel back to 1972, to a decision that even Buffett's closest partner thought was a mistake, a decision that would become one of the foundational case studies in the Berkshire Hathaway curriculum of wealth creation. We must talk about See's Candies. In 1972, Warren Buffett and Charlie Munger were presented with an opportunity to buy a well-known, family-owned chocolate company based in California, See's Candies. The asking price was $30 million. The company was earning about $4 million pre-tax, which translated to roughly $2 million after tax. On the surface, it didn't look like the kind of barn-burner investment that would make history. Buffett offered $25 million. The sellers, the See family, held firm at $30. For a moment, it seemed the deal would fall apart over $5 million. Munger, in his characteristically blunt way, urged Buffett to just pay the $30 million, but Buffett, ever the disciplined value investor, was ready to walk away. Finally, the sellers relented and accepted the $25 million offer. At the time, Munger later confessed he thought they were overpaying. See's Candies was a mature business. It wasn't a technology company. It wasn't going to grow its revenue at 50% a year. It was, in the eyes of the market, a bit boring. But Buffett saw something that the spreadsheets of the day didn't fully capture. He saw a cash machine. What made See's Candies so special was not its growth potential, but its economic characteristics. It was a business of immense, understated power. First, it had a powerful brand. In California, See's was an institution, a symbol of quality and tradition. This brand loyalty gave it pricing power. Every year, almost like clockwork, See's could raise its prices slightly to cover inflation, and then some, and its loyal customers would happily pay. That pricing power translated directly into high profit margins. But the real magic was on the other side of the equation, the capital requirements. See's Candies did not need a vast amount of money to grow. To open a new store required a modest investment in a lease, some counters, and inventory. There were no billion-dollar factories to build, no massive research and development budgets. The business funded its own growth, and then some. In its very first year under Berkshire's ownership, See's generated its $2 million in profit, as expected. But what fascinated Buffett was that it required only a tiny fraction of that profit to be reinvested back into the business to maintain its operations and fund its modest growth. The rest, the vast majority of that profit, was free and clear. It was what Buffett would later call owner earnings. It was cash that could be taken out of the business and sent to Omaha, to Berkshire Hathaway headquarters, to be deployed elsewhere. Over the years, this trickle of cash became a torrent. The initial $25 million investment was recouped in just a handful of years. Since 1972, See's Candies has sent more than $2 billion in free cash flow to Berkshire Hathaway. Let that sink in. A $25 million purchase has produced $2 billion in cash, and the underlying business is still there, still gushing, and is worth many, many times more than the original purchase price. This is the essence of the cash flow imperative. See's wasn't a story of explosive revenue growth. It was a story of extraordinary profitability and ridiculously low capital needs. The cash it produced was not an accounting entry. It was real money that landed in Berkshire's bank account, money that was then used to buy other great businesses like the Buffalo News and parts of Coca-Cola and American Express. See's Candies became the prototype for the perfect Buffett business, one that provides the capital for its parent company to expand, rather than one that consumes it. This experience crystallized for Buffett a core truth. The real value of a business is the cash it can produce for its owners over its lifetime. Net income is an opinion, but cash is a fact. The reason so many investors miss businesses like See's Candies and are instead drawn to cash-burning growth stories lies deep within our cognitive architecture. We are victims of a powerful mental flaw known as the narrative fallacy. Coined by Nassim Nicholas Taleb, the narrative fallacy describes our tendency to create and believe coherent stories to explain random facts and events. Our brains are not built for statistics, they are built for stories. A simple, compelling narrative is far more persuasive to the human mind than a complex set of data, even if that data points to the opposite conclusion. The story of a visionary founder disrupting an industry with explosive revenue growth is a powerful, intoxicating narrative. It's a story of progress, of the future, of changing the world. We hear about soaring user numbers, market share gains, and rapidly increasing sales. This narrative is easy to understand, easy to repeat, and emotionally resonant. It triggers our confirmation bias, where we actively seek out information that supports this exciting story, glowing media articles, bullish analyst reports, while ignoring the boring, contradictory data hidden in the cash flow statement. Warren Buffett's genius is not that he is a better storyteller, it's that he is almost pathologically immune to the story. He operates in a different cognitive domain. He forces himself to ignore the siren song of the narrative and focus exclusively on the unglamorous, unsexy reality of the numbers. He's not asking what's the story. He's asking where's the cash. This is a profound psychological discipline. It requires actively overriding the brain's natural tendency to be seduced by a good tale. The narrative of a company burning through hundreds of millions of dollars in venture capital to capture eyeballs or acquire users is framed as a story of bold investment in the future. Buffett reframes it as a simple question: when will this business ever produce a dollar of cash for its owners? If the answer is, we're not sure, but we're growing fast, he loses interest. This is because he understands that a business that consumes cash requires a constant stream of new capital from outside investors. This capital comes at a cost, either through debt which adds risk, or through issuing new shares, which dilutes the ownership stake of the existing shareholders. A business that gushes cash, like Seas, is the opposite. It is self-funding. It enriches its owners not just through its own operations, but by providing them with capital to do other things. Resisting the narrative fallacy is a conscious act of rebellion against our own mental wiring. It's the choice to favor the boring spreadsheet over the thrilling story, to trust the verifiable past of cash generation over the speculative promise of future growth. It is the psychological bedrock of value investing. So how do we translate this principle into a practical tool? How can we, as investors or entrepreneurs, systematically apply this thinking? The blueprint is a concept Buffett outlined in his 1986 letter to shareholders, the calculation of owner earnings. This is his refinement of standard free cash flow, and it's designed to give a much truer picture of the cash-generating power of a business. The process is a step-by-step journey from the accounting fiction of net income to the economic reality of cash. First, you start with the company's reported net income. This is the bottom line on the income statement, the number that most of the headlines focus on. But it is just the beginning of our analysis. Second, you add back all non-cash charges. The most common of these are depreciation and amortization. These are accounting expenses that are meant to represent the gradual wearing out of assets, but no actual cash leaves the company's bank account for them in the current period. So we add them back to net income to get closer to the cash reality. Third, and this is the crucial Buffett innovation, you must subtract the average annual amount of capital expenditures, or CapEx, that the business requires to maintain its long-term competitive position and its unit volume. This is called maintenance CapEx. This step requires judgment. The cash flow statement gives you a single number for total CapEx in a given year, but it doesn't break down how much of that was for simple maintenance versus how much was for actual growth. Buffett's insight is that the portion of CapEx needed just to stand still, to replace old machines, to keep the stores looking fresh, is a true expense for the owner, just like salaries or rent. It's cash that cannot be taken out of the business. How do you estimate it? One simple way is to look at the depreciation and amortization charge. In a stable business with no growth, CapEx would, over time, roughly equal depreciation. So, for many mature, slow-growing businesses, the depreciation charge is a reasonable proxy for maintenance CapEx. For a growing business, you might need to dig deeper, looking at company disclosures or making a conservative estimate. The key is to acknowledge that some capital spending is not optional. It's a cost of doing business. The resulting number, net income plus depreciation and amortization minus maintenance CapEx, is owner earnings. This figure tells you how much cash the owners could theoretically pocket at the end of the year without harming the long-term health of the business. A truly great business will have owner earnings that are consistently high and growing as a percentage of sales. A mediocre business might have high net income, but its owner earnings will be low because it requires massive amounts of maintenance CapEx just to keep the lights on. By running this calculation for a company over a 5 or 10-year period, you can see the true trend in its economic profitability, stripped of accounting distortions and narrative hype. This mental model is the investor's scalpel, allowing you to dissect a financial report and find the beating heart of the business, its ability to generate spendable cash. To fully appreciate the wisdom of this approach, we must examine its opposite. We must look at the path of the 99%, the path that prioritizes growth at all costs. And there is no more stark example of this folly than the dot-com bubble of the late 1990s. This was an era when the language of revenue growth became the only language spoken. The market was consumed by the narrative fallacy on a grand societal scale. The story was the new economy, where the old rules of profitability and cash flow no longer applied. The internet was changing everything, and the only thing that mattered was securing a dominant position, no matter the cost. Consider a company like Webvan. Its narrative was incredibly seductive. Founded in 1996, it promised to revolutionize the grocery industry. Customers could order groceries online and have them delivered to their door within a 30-minute window. The company was growing its revenue at an astronomical pace. It raised nearly $400 million in its initial public offering in 1999. On its first day of trading, the stock more than doubled, giving the company a market capitalization of over $8 billion, more than the established profitable grocery chains it was meant to replace. The media celebrated its visionary founder and its hyper-growth model, but if you had applied the owner earnings mental model, you would have seen a terrifying picture. Webvan was burning cash at a rate that was almost unbelievable. For every dollar of revenue it generated, it was spending more than $2. Its business model required building massive, technologically advanced warehouses that cost over $30 million each. It required a huge fleet of custom delivery vans and a large salaried workforce. The capital expenditures were gargantuan. Its owner earnings weren't just low, they were massively, horrifyingly negative. The business was a cash incinerator. The path of the 99% accepted the narrative. They are investing for growth. Once they reach scale, they will become profitable. But the unit economics never made sense. The cost of acquiring a customer and fulfilling an order was simply higher than the revenue that order generated. The faster Webvan grew, the more cash it burned. The whole enterprise was dependent on a continuous infusion of new money from the capital markets. When the dot-com bubble burst in 2000 and 2001, the capital markets slammed shut. The story no longer mattered. All that mattered was cash, and Webvan had none. In July 2001, less than 2 years after its celebrated IPO, the company filed for bankruptcy. The $8 billion of market value vanished. Thousands of employees lost their jobs, and investors lost everything. Webvan is the perfect antithesis. It illustrates the catastrophic consequences of ignoring economic reality in favor of a seductive narrative. Growth, when unmoored from the anchor of positive cash flow, is not just meaningless. It is a direct path to self-destruction. The financial connection between this principle and an investor's portfolio is direct, tangible, and profound. Let's imagine two businesses to make this crystal clear. Company A is Growth Co., a darling of the tech media. It has $100 million in revenue, and it's growing at an impressive 50% per year. But to achieve this growth, it spends heavily on marketing and sales, and on building new data centers. Its business model is not yet profitable on a cash basis. In fact, it burns through $20 million of cash each year. Company B is Cash Co., a more mature business in a boring industry, perhaps like See's Candies. It also has $100 million in revenue, but it's only growing at a modest 5% per year. However, its operations are highly efficient and require very little capital investment. It generates $25 million in positive free cash flow, or owner earnings, each year. The investor following the 99% is immediately drawn to Growth Co. The 50% growth rate is exciting, but look at what happens on the balance sheet. To fund its $20 million annual cash burn, Growth Co. must constantly go to the capital markets. It can either take on debt, which increases financial risk and adds interest payments that consume future profits, or it can issue new shares of stock. When it issues new shares, the ownership stake of the existing shareholders is diluted. Your slice of the pie gets smaller and smaller. The company's growth is not creating value for you, it's being paid for by you through dilution. Now look at Cash Co. The 5% growth rate is uninspiring, but the $25 million in annual free cash flow is where the magic happens. The management of Cash Co. has options, all of them good for the owners. They can use that cash to pay a dividend, putting money directly into the shareholders' pockets. They can use it to buy back their own stock. If they buy back stock, the number of shares outstanding decreases, which means each remaining shareholder's slice of the pie gets bigger. Their earnings per share and intrinsic value per share go up, even if the business itself isn't growing much faster. Or, they can use that cash to make a smart acquisition, buying another cash-generative business. The key is that Cash Co. is self-funding. It is an asset that provides capital. Growth Co is a liability that consumes it. Over a decade, the shareholder of Cashco will almost certainly be far wealthier. Their portfolio will have benefited from a steady stream of dividends or the powerful silent wealth creation of share buybacks, while the Growth Co shareholder has likely been diluted into oblivion, waiting for a promise of future profitability that may never arrive. This is the direct financial manifestation of Buffett's core insight. A good business provides cash, a bad business consumes it. All intelligent financial analysis flows from this first, essential distinction. Once we have established the primacy of cash flow, we arrive at the second and perhaps most powerful pillar of the Buffett philosophy, the concept of the business as a compounding machine. It is not enough for a business to simply generate cash. The true engine of long-term wealth creation is what happens to that cash. The profits that a company chooses not to pay out as dividends are called retained earnings. For most investors, this is just an obscure line on the balance sheet. For Warren Buffett, it is the secret fuel of the greatest wealth-creating force in the universe: compounding. The core principle is this: a business that can take its retained earnings and reinvest them at a high rate of return will, over time, become exponentially more valuable. This is the very heart of the virtuous cycle. To understand its origins in Buffett's own mind, we have to go back to the beginning, to the business that gave Berkshire Hathaway its name, and to the painful lesson it taught him. In the mid-1960s, Warren Buffett took control of a struggling New England textile manufacturer, Berkshire Hathaway. He was a young, brilliant investor, and he thought he could turn it around. The textile business, on the surface, looked like it should work. People would always need textiles. The company had revenue, it had assets, and with better management, Buffett believed it could have profits. But he soon ran into a brutal economic reality. The American textile industry was facing intense competition from overseas, where labor costs were much lower. To stay even remotely competitive, Berkshire's textile mills required constant, heavy capital investment. The looms were always becoming obsolete. New technology was always needed just to keep pace. Each year, any meager profits the business managed to eke out had to be immediately plowed back into buying new equipment. The retained earnings were being reinvested, but the rate of return on that new investment was abysmal, often close to zero. Buffett likened it to running on a treadmill. You had to run faster and faster, invest more and more capital, just to stay in the same place, maintain your competitive position. The business was a capital sinkhole. It consumed every dollar it earned and more, with nothing left over for the owners. The experience was agonizing, but it taught him the most valuable lesson of his career. He contrasted the grim reality of the textile mills with the joyful economics of a business like See's Candies, which he bought a few years later. See's also had retained earnings, but when See's reinvested a dollar to open a new store, that dollar generated a very high rate of return. The business didn't need much capital, and the capital it did need was incredibly productive. This stark contrast between the two businesses forged the second pillar of his philosophy. He realized that the determining factor in long-term business success was not just the ability to earn money, but the return a company could earn on the money it reinvested. He famously said that the ideal business was one that could earn high rates of return on large and growing amounts of capital. The textile mill could, at best, earn low returns on the capital it was forced to reinvest. It was a compounding machine in reverse, destroying value over time. This painful, first-hand experience with a terrible business is what gave him such a profound appreciation for a truly great one. He learned that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, because the wonderful company's ability to compound its retained earnings at a high rate will create value far beyond what a cheap price can offer. The reason that the power of this compounding machine is so consistently underestimated, even by sophisticated people, is due to another deep-seated cognitive flaw, the exponential growth bias. Our brains evolved in a world of linear, not exponential, change. If a lion is running towards you, you can linearly extrapolate its path and get out of the way. As a result, we are intuitively good at thinking in straight lines, but we are absolutely terrible at grasping the explosive power of an exponential curve. The classic illustration of this is the story of the emperor and the chessboard. A wise man presents a beautiful chessboard to an emperor, who is so pleased that he offers the man any reward he desires. The man makes a seemingly humble request: place 1 grain of rice on the first square of the chessboard, 2 on the second, 4 on the third, and so on, doubling the amount for each of the 64 squares. The emperor, thinking linearly, readily agrees, scoffing at the small size of the reward. He thinks it's a few bags of rice at most. In the first half of the chessboard, the numbers are manageable. By the 32nd square, the pile is large, but conceivable, about 4 billion grains of rice. But it is in the second half of the chessboard that the exponential function explodes into insanity. The final square alone would require over 18 quintillion grains of rice, more rice than has ever been produced in the history of the world. The emperor is bankrupted. This is the exponential growth bias in action. We see the early, flat part of the curve and project it forward in a straight line, completely failing to anticipate the violent upward turn. The same bias governs how we think about investing. We see a company that earns a consistently high return on its capital, say 20% a year, and we might think, that's a good return. We fail to truly internalize what that means over 10, 20, or 30 years. A company that can consistently reinvest its profits at 20% will not just grow, its intrinsic value will explode, following the same logic as the rice on the chessboard. Small, consistent gains, when compounded, lead to outcomes that defy our linear intuition. Buffett's entire career is a testament to his ability to override this bias. He doesn't just look at a company's earnings this year. He looks at its ability to retain those earnings and reinvest them at high rates, and he mentally follows that exponential curve out for decades. He is playing on the second half of the chessboard, while most of the market is fixated on the first few squares. To turn this powerful concept into a concrete tool for business analysis, we can use a framework called the ROIC to growth model. This is the blueprint for quantifying a company's ability to act as a compounding machine. It breaks the process down into its 2 essential components: profitability and reinvestment. The first step is to calculate the company's return on invested capital, or ROIC. This is arguably the most important single metric in all of financial analysis. It tells you how efficiently a company is using its capital to generate profits. To calculate it, you first need the numerator, net operating profit after tax, or NOPAT. This is the company's operating profit, with the taxes on that profit taken out. It represents the total profit generated by the core business operations, before considering the effects of debt. The denominator is invested capital. This is the total amount of money that has been invested in the business by both its shareholders and its lenders. A common way to calculate it is to take total equity and add total debt, and then subtract any cash on the balance sheet that is not essential for operations. By dividing NOPAT by invested capital, you get the ROIC. A company with an ROIC of 20% is generating 20 cents of operating profit each year for every dollar of capital invested in the business. This is a powerful measure of profitability. The second step is to calculate the company's reinvestment rate. This tells you what percentage of its profits the company is plowing back into the business to fund future growth. This is the fuel for the compounding engine. It is calculated by taking the company's net capital expenditures, CapEx minus depreciation, and adding the change in its net working capital, and then dividing that sum by the NOPAT. A reinvestment rate of 50% means the company is taking half of its profits and putting them back into the business, presumably to grow. The third and final step connects these 2 metrics to create a powerful forecast. The company's sustainable growth rate can be estimated by a simple formula. Growth equals ROIC multiplied by the reinvestment rate. Let's say a company has an ROIC of 20% and a reinvestment rate of 50%. Its sustainable growth rate would be 10%, 0.20 times 0.50. This elegant little formula is the engine of compounding made manifest. It shows you that growth is not some magical force. It is the direct result of two managerial decisions: how profitably you run the business, ROIC, and how much you reinvest in it, reinvestment rate. A company that wants to grow faster has only two options: increase its ROIC or increase its reinvestment rate. This framework allows an intelligent investor to move beyond simply looking at past growth and start analyzing the underlying drivers of future growth. It provides a blueprint for identifying a true compounding machine. Now let's look at the antithesis, the path of the 99%, which so often leads to the destruction of value. This is the trap of diversification. The term was coined by legendary investor Peter Lynch to describe a common corporate sin. A company with a wonderful high-return core business generates a great deal of cash, but then its management, suffering from empire-building bias, proceeds to squander that cash on a series of foolish acquisitions in industries they don't understand. They are reinvesting the retained earnings, but they are doing so at disastrously low rates of return. A classic example from business history is the downfall of the conglomerate ITT in the 1960s and 70s under its CEO Harold Janine. ITT started as a solid telecommunications company, but Janine was obsessed with growth, specifically with delivering smooth, predictable earnings growth of 10% every single quarter. To achieve this, he went on an acquisition binge of unprecedented scale, buying hundreds of companies in completely unrelated industries: Sheraton Hotels, Avis Rent-A-Car, Hartford Insurance, a baking company, a producer of silica for glass. The narrative was that a superior management team could run any business. The reality was diversification. ITT was taking the cash from its decent core business and reinvesting it into a sprawling, incoherent collection of mediocre businesses. The return on this new invested capital was often very low. The complexity of the organization became unmanageable. While the company's reported earnings per share grew for a time, its underlying economic reality was deteriorating. The company became a bloated, inefficient behemoth. When Janine retired, the conglomerate eventually had to be broken up, with much of the value that had been built in the core business having been squandered on these ill-advised acquisitions. This is the path of the 99%: generate cash and then destroy it through undisciplined reinvestment. It is the compounding machine running in reverse. The management is retaining the earnings, but instead of reinvesting them at high rates of return, they are diversifying at low rates, destroying the very shareholder value they are supposed to be creating. The direct financial connection between a high ROIC and long-term wealth is something that can be precisely quantified. Let's construct a simple financial model of two companies over a 10-year period. Both Company A and Company B start with an identical book value or invested capital of $100 per share. Company A is a compounding machine. It has a durable competitive advantage that allows it to consistently generate a high return on invested capital of 25%. The management is disciplined. They decide to reinvest half of their profits back into the business each year, a 50% reinvestment rate, and pay out the other half as a dividend. Company B is a mediocre grower. It operates in a more competitive industry and can only manage to earn a 10% ROIC. Its management, however, is obsessed with growth. They decide to reinvest 100% of their profits back into the business, paying no dividend. Let's trace the book value per share for each company over 10 years. In year 1, Company A earns $25 in profit, 25% of $100. It reinvests half, which is $12.50. Its book value at the end of year 1 is $112.50. In year 1, Company B earns $10 in profit, 10% of $100. It reinvests all of it. Its book value at the end of year 1 is $110. Already, Company A is ahead, despite reinvesting less money in absolute terms. Why? Because each dollar it reinvested was far more productive. Let's fast forward to the end of year 10. After a decade of compounding its book value at 12.5% per year, 25% ROIC times 50% reinvestment, Company A's book value per share will have grown to approximately $325. Plus, the shareholder would have received a steadily growing stream of dividends along the way. Company B, compounding its book value at 10% per year, 10% ROIC times 100% reinvestment, will see its book value grow to approximately $260. And the shareholder has received zero dividends. The shareholder of Company A is vastly wealthier. This simple model demonstrates the incredible power of a high ROIC. It is the governor on the engine of compounding. A business with a high ROIC can create enormous wealth even with a moderate reinvestment rate. A business with a low ROIC can reinvest aggressively for years and create very little real value for its owners. This is the mathematical certainty behind Buffett's focus. He is not just looking for profits, he is looking for profitable reinvestment opportunities, for businesses that can take their retained earnings and turn them into exponentially greater future earnings. This is the direct, quantifiable financial advantage of owning a true compounding machine. We have established that the goal is to find a business that gushes cash and can reinvest that cash at high rates of return. This leads us to the third, crucial pillar. How do we identify these rare and wonderful businesses in the first place? The answer lies not just in the numbers, but in the qualitative characteristics of the business itself. Warren Buffett's great insight is that certain businesses, due to their structure and competitive positioning, are virtual locks to be cash-generative compounding machines. These businesses possess what he calls a durable competitive advantage, or an economic moat. A moat is a structural feature of a business that protects it from competition, allowing it to earn high returns on capital for a very long period of time. Just as a medieval castle used a wide moat filled with water to fend off invaders, a great business uses its economic moat to fend off competitors who would love to steal its profits. Identifying these moats is one of the most important skills in value investing. And to see this principle in action, we must go back to one of the darkest and most uncertain moments in Wall Street history, the Great Salad Oil Scandal of 1963. The story begins with a small, seemingly insignificant company in New Jersey called the Allied Crude Vegetable Oil Refining Corporation, run by a man named Tino DeAngelis. DeAngelis had a clever scheme. He would borrow money against his company's vast inventory of salad oil, which was stored in giant tanks in Bayonne, New Jersey. The leading lender in this field was a subsidiary of American Express, which would issue warehouse receipts for the oil, which DeAngelis would then use as collateral for loans. The problem was, most of the salad oil didn't exist. The tanks were mostly filled with water, with a few feet of oil floating on top. When inspectors came to check, they would measure from the top and see what they expected. It was a massive fraud. In November 1963, the music stopped. Allied Crude defaulted on its loans and filed for bankruptcy. Wall Street panicked. The central fear was that American Express, having issued the now worthless warehouse receipts, would be on the hook for the entire $150 million in fraudulent loans, a colossal sum at the time that threatened to bankrupt the company. The market's reaction was swift and brutal. American Express stock, which had been trading at over $60 a share, collapsed, plunging by nearly 50% to $35. The narrative was one of fear and ruin. This was a classic blood in the streets moment. But a young Warren Buffett, running his investment partnership in Omaha, saw the panic not as a threat, but as an opportunity. He didn't just read the headlines, he did the work. He decided to investigate the underlying business of American Express to see if the market's fears were justified. He went out and conducted what he called scuttlebutt research. He visited restaurants and banks. He talked to merchants who accepted American Express cards and traveler's checks. He talked to their competitors. And what he discovered was that the salad oil scandal, while a serious financial blow, had done absolutely nothing to damage the core business of American Express. He found that customers were not abandoning their American Express cards, travelers were not shying away from its traveler's checks, merchants were not refusing to accept them. Why? Because American Express had a powerful intangible moat around its business, the trust of its brand. People all over the world associated American Express with financial security and reliability. This one incident, as bad as it was, wasn't enough to shake that deep-seated belief. He realized that the payments and travelers' check business was a phenomenal economic machine. It operated on float. Customers would give American Express money for travelers' checks, and Amex could hold that money and invest it for its own profit until the checks were cashed. It was a business that required very little capital and gushed cash. Buffett concluded that the fundamental earning power of the business was intact, and that the stock was trading at a ridiculously cheap price because the market was panicking over a one-time, albeit large, loss. He confidently invested 40% of his partnership's capital into American Express stock, making it his single largest investment. Over the next few years, as the company absorbed the salad oil losses and its powerful core business continued to churn out profits, the stock price recovered and soared. Buffett made a fortune for his partners. This story is the perfect illustration of Pillar 3. He looked past the short-term crisis and identified the durable competitive advantage, the brand, that would ensure the company's long-term profitability and cash generation. The market's panicked reaction to the salad oil scandal and Buffett's calm, analytical response can be explained by two powerful psychological principles: the availability heuristic and the affect heuristic. The availability heuristic is a mental shortcut where we judge the likelihood of an event based on how easily examples of it come to mind. In late 1963, the story of the scandal was everywhere. It was vivid, dramatic, and easily available to everyone's mind. The word fraud and bankruptcy were plastered across the front pages of newspapers. As a result, investors dramatically overestimated the probability that American Express would actually fail. The scary, available story crowded out the more complex, less available reality of the company's underlying business strength. This was amplified by the affect heuristic, which is our tendency to let our emotions, our affect, guide our judgments and decisions. The story of the scandal elicited a powerful emotional response: fear. Fear leads to a desire to flee, to sell, to get away from the perceived danger. The decision to sell Amex stock was not, for most people, a rational calculation of probabilities and intrinsic value. It was an emotional reaction to a scary headline. Buffett's superpower is his ability to short-circuit these heuristics. He practices what psychologist Daniel Kahneman calls system 2 inches thinking. While the rest of the market was using their fast, intuitive, emotional system 1 inch brain, Buffett engaged his slow, deliberate, analytical system 2 inches brain. He consciously ignored the emotionally charged, easily available narrative and forced himself to focus on the fundamental questions. What is the nature of the business? Does it have a moat? What is its long-term earning power? By replacing emotional reaction with rational analysis, he was able to see the durable competitive advantage that the rest of the market, blinded by fear and cognitive shortcuts, had completely overlooked. This psychological discipline is just as important as financial acumen in identifying the great cash-gushing businesses. How can we systematically identify these moats? The blueprint for this is a moat identification checklist, which breaks down the concept into 4 main categories of durable competitive advantages. When analyzing a company, an intelligent investor should ask which, if any, of these moats it possesses. First, intangible assets. This includes things like brands, patents, and regulatory licenses. A powerful brand, like Coca-Cola's, allows a company to charge more for its product than a generic competitor, leading to higher profit margins. The test for brand power is pricing power. Can the company raise prices without losing significant business to competitors? Patents give a pharmaceutical company a temporary monopoly on a drug, allowing it to generate enormous free cash flow. Regulatory licenses, like the ones needed to operate a railroad or a waste disposal service, can create a powerful barrier to entry for new competitors. Second, switching costs. This moat exists when it is expensive, time-consuming, or just plain annoying for a customer to switch from one provider to another. Think about the bank, where you have your primary checking account. Moving all your direct deposits, automatic bill payments, and linked accounts to a new bank is a massive hassle. This inertia is a powerful switching cost that keeps you as a customer, allowing the bank to earn steady profits. Enterprise software companies, like Oracle or SAP, are classic examples. Once a large corporation has built its entire operations around a specific software suite, the cost and risk of switching to a new one are astronomical. Third, network effects. A business has a network effect when its product or service becomes more valuable to each user as more people use it. The classic examples are credit card networks like Visa and MasterCard. The more merchants that accept Visa, the more useful it is for cardholders. The more cardholders who have Visa, the more essential it is for merchants to accept it. It's a self-reinforcing loop that creates a duopoly that is almost impossible for a new competitor to break into. Social media platforms like Facebook and marketplaces like eBay also benefit from powerful network effects. Fourth, cost advantages. This moat comes from a company's ability to produce a product or service at a significantly lower cost than its competitors. This can come from two main sources. The first is scale. A company like Walmart or Costco can negotiate better prices from suppliers than a small retailer because they buy in such huge volumes. They can then pass those savings on to customers, creating a low price advantage that is very difficult to compete with. The second source is a unique process or location. A company like Geico, which pioneered the direct-to-consumer model for auto insurance, had a structural cost advantage over competitors who had to pay commissions to a large network of agents. By using this four-part checklist, intangible assets, switching costs, network effects, and cost advantages, an investor can move from a vague sense that a company is good to a precise understanding of the source of its competitive strength. A business with one or more of these deep, structural moats is highly likely to be a cash gusher and a compounding machine for years to come. The antithesis of a moated business is a company stuck in what Buffett calls the commodity trap. A commodity business is one where the product or service is undifferentiated from its competitors. Customers buy based on one factor and one factor alone: price. These businesses have no moat. They are castles built on sand, completely exposed to the relentless tides of competition. And Buffett's classic example of a commodity trap has always been the airline industry. For decades, the airline industry has been a marvel of technology and a destroyer of capital. Think about it from the perspective of our moat checklist. Do airlines have powerful brands? Not really. Most travelers will choose an airline based on price and schedule, not brand loyalty. Are there switching costs? No. It's easy to book your next flight on a different airline. Are there network effects? Some, at hub airports, but not strong enough to prevent brutal price competition on most routes. Do they have cost advantages? Some are more efficient than others, but their major costs, fuel, labor, and aircraft, are largely similar across the industry. The result is a business with no pricing power and intense, cutthroat competition. Anytime the industry starts to become profitable, a new competitor can easily enter the market, lease some planes, and start a price war, driving profits back down to zero or worse. The business also requires massive, continuous capital expenditures to buy new planes. It is the polar opposite of See's Candies. It is a business that consumes cash rather than producing it. Buffett himself invested in U.S. Airways in 1989 and called it a huge mistake, souring him on the industry for decades. The airline industry is the perfect example of the path of the 99%, chasing revenue growth in a structurally flawed, commodity-like business, a recipe for long-term value destruction. The financial connection between a moat and a company's performance is not theoretical. It is written in black and white on the financial statements. Let's compare the key financial metrics of a hypothetical moated business. MoatTech, a dominant software company, with a hypothetical commodity business. ComAir, a generic airline. First, look at the gross margin, which is revenue minus the cost of goods sold. Moat Tech, which sells software that can be replicated at virtually zero marginal cost, might have a gross margin of 90%. Comair, which has to pay for fuel, crew, and maintenance for every flight, might have a gross margin of 15%. This initial difference in profitability is a direct result of the business model. Next, look at the net profit margin, which is the net income as a percentage of revenue. Moat Tech, because of its pricing power and low capital needs, might have a net margin of 30%. It is a highly profitable enterprise. Comair, after paying for all its operating expenses, interest on its debt to buy planes, and taxes, will be lucky to have a net margin of 2% in a good year. In a bad year, it will be negative. The margin is thin and volatile. Finally, and most importantly, look at the return on invested capital, ROIC. Moat Tech, with its high profits and asset-light business model, might generate an ROIC of over 40%. Every dollar invested in the business generates a huge return. Comair, with its low profits and massive investment in aircraft, will have a chronically low ROIC, often in the single digits, and frequently below its cost of capital, meaning it is actively destroying value. This comparison makes the financial connection starkly clear. The qualitative concept of an economic moat translates directly into superior and more reliable quantitative results: higher margins, higher profitability, and a higher return on invested capital. This financial superiority is what allows the moated business to gush cash and act as a compounding machine, creating immense long-term wealth for its owners. We have now established that we are looking for a cash-gushing business with a wide moat that allows it to reinvest its profits at high rates of return. But there is one final, critical component: the human element. A great business can be ruined by a poor manager, just as a mediocre business can be significantly improved by a great one. This brings us to the fourth pillar of the Buffett philosophy: the paramount importance of capital allocation. Once a business has generated its cash, the chief executive officer faces a crucial set of decisions about what to do with it. This, Buffett argues, is the CEO's most important job. The intelligence with which they allocate the company's capital will have a greater impact on long-term shareholder returns than almost any other operational factor. To see this principle in its most vivid form, we can look to Buffett's relationship with one of the greatest publishers of the 20th century, Katharine Graham of the Washington Post. In 1973, in the midst of the Watergate scandal, Warren Buffett began quietly buying up shares of the Washington Post company. He saw what the market was missing. The Post was not just a newspaper, it was a dominant media franchise in a major city, a business with a powerful local moat. It gushed cash. But he also saw that the company's management, led by Katharine Graham, while being brilliant journalists, were not necessarily thinking like disciplined investors when it came to the company's capital. The company had a hodgepodge of other assets and wasn't aggressively buying back its own, deeply undervalued stock. After becoming a major shareholder and joining the board of directors, Buffett began a long and fruitful mentorship of Graham. He didn't tell her how to run the newspaper. That was her area of expertise. He taught her how to think about capital allocation. He explained the mathematical logic of share buybacks. When the stock of a great business is trading for less than its intrinsic value, the single best use of corporate cash is to buy back its own shares. It's like buying a dollar bill for 50 cents, and it instantly increases the per-share value for the remaining shareholders. He taught her to be disciplined about acquisitions, to only buy businesses that she could understand and that would earn high returns on capital, and to avoid the temptation of, quote, diversification. He taught her to think of the company's retained earnings not as the company's money, but as the shareholders' money, and to deploy it with the same care and focus on returns that a prudent investor would. Katharine Graham proved to be a brilliant student. She embraced this new way of thinking and became one of the most astute capital allocators of her generation. Under her leadership, the Washington Post company used its prodigious cash flow to aggressively buy back its own shares at bargain prices. It made shrewd acquisitions, like buying cable companies when they were cheap. The result was one of the most spectacular investment returns in history. A $10,000 investment in the Washington Post Company, when Buffett first bought it, would have grown to over $1 million 2 decades later. This phenomenal success was not just because the Post was a great business. It was because Katharine Graham, guided by Buffett, became a master of capital allocation, intelligently reinvesting the cash that the great business produced. The reason so many CEOs fail at this critical task of capital allocation is rooted in a fundamental conflict in corporate governance known as the agency problem, and a related psychological flaw, the empire-building bias. The agency problem describes the inherent conflict of interest between the shareholders of a company, the principals, and the management team hired to run it, the agents. In theory, the CEO works for the shareholders. In practice, their incentives may not be aligned. The empire-building bias is a powerful manifestation of this problem. Many CEOs are psychologically driven not by a desire to maximize per-share intrinsic value for their owners, but by a desire to preside over the largest possible enterprise. Their compensation, their prestige, and their sense of self-worth are often tied to the size of the company's revenues, its headcount, or its global footprint. This bias leads to predictable and value-destructive behaviors. An empire-building CEO who finds their company with a pile of cash will feel an institutional imperative to do something with it. Sitting on cash feels passive. Making a large, headline-grabbing acquisition feels active and important, even if the acquisition makes no financial sense. They will often overpay for acquisitions, lured by the promise of synergies that rarely materialize. They will chase revenue growth in low-margin businesses, expanding the empire but lowering its overall profitability and return on capital. They are often reluctant to buy back stock, even when it's cheap, because it shrinks the company's balance sheet. They are even more reluctant to pay a large dividend, as it admits that they have run out of good ideas for reinvesting the capital themselves. Warren Buffett, in his search for great investments, is not just analyzing the business. He is psychoanalyzing the CEO. He is looking for a manager who has transcended the agency problem, who resists the allure of empire building, and who thinks like a true owner. He wants a CEO whose primary goal is not to be the biggest, but to be the most valuable on a per-share basis. Finding this rare breed of manager is a key part of his investment process. How can a rational CEO or an investor evaluating a CEO make consistently good capital allocation decisions? The blueprint is a capital allocation decision tree, a logical, hierarchical process for deploying corporate cash. It provides a clear framework that prioritizes the creation of shareholder value at every step. The first question at the top of the tree is this: can we find opportunities to reinvest this cash back into our core business at a high rate of return? This is always the best and first option. It could mean building a new factory, spending on research and development for a new product, or expanding the sales force. If a company can earn, say, a 25% return on capital, and it has opportunities to reinvest its earnings at that same high rate, it should do so all day long. This is the engine of organic compounding. If, and only if, the answer to the first question is no, meaning there are no more high-return opportunities within the core business, do you move to the second question? Can we acquire another business that we understand well and that is likely to generate a high rate of return on our invested capital? This is the path of acquisitions. It must be approached with extreme discipline. The CEO must avoid overpaying and must stick to businesses within their circle of competence, their area of expertise. Most acquisitions fail to create value. A good capital allocator is very selective here. If the answer to both of the first two questions is no, you proceed to the third question: is our company's stock currently trading in the market for a price that is significantly below our conservative estimate of its intrinsic value? If the answer is yes, then buying back the company's own shares is a highly attractive and tax-efficient way to use the cash. Every share repurchased increases the remaining shareholders' ownership percentage of the business, creating value for them. Finally, if the answer to all three of the above questions is no, there are no good internal projects, no smart acquisitions to be made. and the stock is fairly priced or overpriced, then you reach the default option at the bottom of the decision tree. Return the cash to the owners in the form of a dividend. This is an admission by management that the shareholders can likely find a better use for the capital than the company can at that moment. It is the honest and honorable thing to do. By analyzing a CEO's past decisions through the lens of this decision tree, reading their annual letters, looking at their history of acquisitions, share buybacks, and dividends, an investor can get a very clear picture of their skill as a capital allocator. A great CEO lives by this logic. A poor CEO makes these decisions based on ego, ambition, and institutional pressure. The antithesis of this rational approach is what we can call the stupid share buyback. This is the path followed by the vast majority of corporate managers, and it is a perfect example of how to destroy value through poor timing and flawed incentives. Many CEOs are incentivized with stock options, which become more valuable as the company's earnings per share, EPS, goes up. A quick way to boost EPS is to reduce the number of shares outstanding through a buyback. This creates a powerful temptation to buy back stock regardless of its price. What often happens is a perverse cycle. When the business is doing well and the stock price is at an all-time high, the company is flush with cash. Feeling confident and pressured to do something with the money, the CEO authorizes a massive share buyback program, buying shares at the top of the market. Then, a recession hits, or the company faces a challenge. The business slows down, cash becomes scarce, and the stock price plummets. This is precisely the moment when a buyback would be most accretive to shareholder value. But what does the typical CEO do? They cancel the buyback program to conserve cash. They are systematically buying high and then refusing to buy low. This is the exact opposite of what an intelligent investor would do, and it is a shockingly common practice in corporate America. It represents a fundamental failure of capital allocation, driven by a combination of flawed incentives and a herd mentality, fear of being bold when others are fearful. The direct financial connection between intelligent capital allocation and shareholder returns can be quantified with a simple simulation. Let's imagine two identical companies, Smart Allocators Inc. and Empire Builders LLC. Both operate the exact same business and generate $10 million in free cash flow every year for 5 years. Both have 1 million shares outstanding at the start, and their stock price fluctuates with the market, being worth $100 per share in good years and $50 per share in bad years. The CEO of Smart Allocators follows the Buffett playbook. In the good years, when the stock is at $100, she sees that it's fairly priced and decides to pay out the $10 million in cash flow as a dividend. In the bad years, when the stock drops to $50, she sees a bargain. She suspends the dividend and uses the entire $10 million to buy back stock. At $50 a share, she can repurchase 200,000 shares. The CEO of Empire Builders does the opposite. In the good years, when the stock is at $100 and cash is plentiful, he feels pressure from Wall Street to, quote, support the stock. He uses the $10 million to buy back 100,000 shares. In the bad years, when the stock is at $50, he gets scared. He conserves cash and does nothing. Let's look at the result after 5 years, assuming 2 bad years and 3 good years. Smart allocators will have repurchased 400,000 shares in total during the 2 bad years. They now have only 600,000 shares outstanding. Their ownership has been concentrated by 40%. Empire Builders will have repurchased 200,000 shares during the 2 good years when their stock was at its peak. They have 800,000 shares outstanding. Now, in year 6, let's say the business earns $10 million again. For Smart Allocators, the earnings per share will be $16.67, $10 million per 600K shares. For Empire Builders, the earnings per share will be only $12.50, $10 million per 800K shares. The per-share earnings power, and thus the intrinsic value per share of Smart Allocators, is a full 33% higher. The underlying business was identical. The only difference was the intelligence of their capital allocation. This is the tangible, massive financial advantage created by a CEO who thinks like an owner and acts with discipline and rationality. We have now assembled the critical components of the Buffett philosophy. We seek a business that gushes cash, protected by a durable competitive moat, run by a management team of skilled and rational capital allocators. This brings us to the fifth and final pillar, the culmination of the entire process, adopting the owner's mindset to value the business. This is where we synthesize all the previous elements into a single, cohesive framework for making an investment decision. It's about learning to see a share of stock not as a flickering quote on a screen, but as a fractional ownership of a real business. The goal is to calculate the intrinsic value of that business, and then, and only then, to look at the market price to see if it is being offered at a significant discount. The ultimate expression of this mindset was perhaps Buffett's monumental investment in the Coca-Cola Company, starting in 1988. Following the stock market crash of October 1987, fear and uncertainty gripped the market. Many great businesses saw their stock prices languish for months, despite their underlying operations being as strong as ever. Coca-Cola was one of them. To the average investor, it was just another stock that had gone down. But Warren Buffett saw something entirely different. He saw a business that perfectly embodied the first four pillars of his philosophy. Coca-Cola was a cash-gushing machine. Its business model was capital light. It primarily sold syrup concentrate to its bottlers, meaning it didn't have to own the bottling plants, trucks, and inventory. This resulted in fantastically high returns on capital. It had one of the most powerful moats in the world, its brand, a global symbol of refreshment and happiness. And it was run by a management team, led by Roberto Goizueta, who were brilliant capital allocators, focused on creating shareholder value. With all these pieces in place, Buffett then executed the fifth pillar. He adopted the mindset of a private owner looking to buy the entire company. He asked himself, if I had the money to buy all of Coca-Cola, what would it be worth to me? The answer, he knew, was the total sum of all the cash the business would produce from that day until Judgment Day, with those future cash flows discounted back to their value in the present. He wasn't focused on what the stock would do next month or next year. He was thinking about the torrent of cash that the global consumption of Coke, Diet Coke, and Sprite would generate for decades to come. He mentally projected the company's growth, its margins, its cash flows, far out into the future. He saw it as a royalty on the ever-increasing thirst of a growing global population. When he did this calculation, he concluded that the intrinsic value of the business was far, far higher than the price at which its shares were trading in the public market. The market, gripped by post-crash fear, was offering him the chance to buy $1 of incredible business value for perhaps 50 or 60 cents. Over 1988 and 1989, Berkshire Hathaway invested over $1 billion, buying up a substantial stake in Coca-Cola. It was one of the largest and most concentrated bets of his career, and it was a direct result of applying this final, all-encompassing pillar. The market's short-term focus, which created the opportunity in Coca-Cola, is a manifestation of a deep-seated human cognitive bias called hyperbolic discounting, also known as present bias. This is our powerful, innate tendency to prefer a smaller, immediate reward over a larger, delayed reward. We are wired to prioritize the present. If offered the choice between $100 today or $110 in a month, many people will take the $100 today, even though the implied interest rate is astronomical. We heavily discount the value of the future. In financial markets, this bias runs rampant. Investors overreact to the latest quarterly earnings report, the most recent news headline, or the current market sentiment. They are focused on the immediate reward of a stock price going up in the near term. This present bias makes it psychologically difficult for them to properly value the long-term, durable, cash-generating power of a great business. A bad quarter for a great company feels like a huge problem, while decades of future profits feel distant, abstract, and less valuable. Warren Buffett's mindset represents a profound cognitive arbitrage over this bias. His time horizon is not next quarter, it's forever. He is willing to forego the immediate gratification of a speculative gain for the much larger, delayed reward that comes from owning a compounding machine for decades. He is effectively using a much lower mental discount rate than the average investor. This allows him to remain calm and buy when others are panicking over present-day fears, and to be patient and hold when others are chasing immediate gains in speculative fads. This ability to overcome present bias and adopt a truly long-term perspective is the final psychological key that unlocks the power of his entire investment philosophy. He is not just buying a stock, he is buying a claim on a decades-long stream of future cash flows, and he has the patience to wait for them to arrive. So how can we translate this owner's mindset into a practical valuation blueprint? The tool for this is a conceptual back-of-the-envelope version of a discounted cash flow or DCF analysis. You don't need a complex spreadsheet with dozens of variables. What you need is a framework for thinking logically about a business's future. Step 1 is to estimate future cash flows. You begin by calculating the company's current owner earnings, using the method we established in Pillar 1. This is your baseline. Then you must project these earnings out into the future, perhaps for the next 10 years. You don't do this by pulling a number out of thin air. You use the ROIC to growth model from Pillar 2. By estimating the company's sustainable ROIC and its likely reinvestment rate, you can make a reasoned projection of how quickly its owner earnings will grow. This grounds your forecast in the underlying economics of the business. Step 2 is to estimate a terminal value. A great business doesn't stop generating cash after 10 years. The terminal value is an estimate of what the business will be worth at the end of your projection period. A simple and conservative way to do this is to take the owner earnings in year 10 and apply a reasonable multiple to it, say 10 to 15 times. This represents the value of all the cash flows from year 11 into perpetuity. Step 3 is to discount everything back to today. This is the crucial step that accounts for the time value of money and risk. $1 tomorrow is worth less than $1 today. The discount rate is your required rate of return. A common practice is to use a rate that reflects the risk-free rate, like the yield on a long-term government bond, plus an equity risk premium to compensate you for the additional risk of owning stocks. You apply this rate to each year's projected cash flow and to the terminal value to find out what they are all worth in today's dollars. Step 4 is to sum it up and apply a margin of safety. You add up the present values of all the projected cash flows and the terminal value. The sum is your estimate of the company's intrinsic value. But the future is uncertain, and your projections could be wrong. So you apply a margin of safety, a principle taught by Buffett's mentor Benjamin Graham. You only buy the stock if the current market price is significantly below your calculated intrinsic value, perhaps 25, 30, or even 50% lower. This discount provides a cushion against errors in judgment and unforeseen problems, and it is the source of your future returns. This entire four-step process is the logical culmination of the owner's mindset. It forces you to think about a business as a long-term cash generator, not a short-term stock chart. The path of the 99% stands in stark contrast to this disciplined, intrinsic value approach. The vast majority of market participants engage in relative valuation. They do not attempt to figure out what a business is fundamentally worth on its own. Instead, they decide if a stock is cheap or expensive by comparing its valuation multiples, like the price-to-earnings PE ratio, to those of its competitors or to its own historical average. This is like trying to guess a person's weight not by putting them on a scale, but by looking at the weights of the other people in the room. If everyone in the room is overweight, a merely overweight person might look thin by comparison. During a market bubble, this is exactly what happens. Every company in a hot sector trades at a PE ratio of 50. A new company comes along and trades at a PE of 40, and analysts call it cheap. But the entire group may be wildly overvalued relative to its intrinsic ability to generate cash. Relative valuation is a game of chasing momentum and sentiment. It is unmoored from the anchor of economic reality. It is the intellectual framework that enables bubbles to form and is the reason so many investors buy high and sell low, caught up in the madness of crowds. The direct financial connection of the owner's mindset, the final, beautiful proof of this entire philosophy, is evident in the actual results of Buffett's Coca-Cola investment. His initial investment of just over $1 billion gave Berkshire Hathaway a stake of about 400 million shares, adjusted for splits. Let's look at the cascade of cash that followed. By the year 2022, Coca-Cola was paying a dividend of approximately $1.76 per share. For Berkshire's 400 million shares, this translated into over $700 million in cash dividends in a single year. Think about that. Every year, Berkshire receives a cash payment that is equal to roughly 70% of its entire original investment. The initial billion-dollar cost was recouped many times over just from dividends alone, and this doesn't even touch on the capital appreciation. That $1 billion stake is now worth over $25 billion. This is the final promise fulfilled. The long-term value of the business was, in fact, the discounted value of its future cash flows. By correctly estimating that value, ignoring the market's short-term fears, and buying with a margin of safety, Buffett executed one of the most successful investments of all time. It stands as the ultimate testament to the power of this entire system of thought. Find a wonderful business that gushes cash and value it based on the promise of all the cash it will deliver for decades to come. You have just spent this time internalizing a powerful mental toolkit. You've moved beyond the superficial language of the market and learned to speak the language of economic reality. You now understand how to look at a business through the same lens as Warren Buffett, to see it not as a ticker symbol but as a cash machine. You have absorbed the critical importance of retained earnings, the explosive power of compounding fueled by a high return on invested capital, and the necessity of a durable economic moat. This is not just theory. It is a practical framework for making intelligent financial decisions, a foundation for the creation of long-term wealth. But what you have just mastered, as powerful as it is, represents a single, crucial pillar in a much larger structure. Buffett's success does not come from one mental model, but from a latticework of interconnected models, borrowed from disciplines like psychology, engineering, and biology. The cash flow model you've just learned is the engine. But to navigate the complex territory of markets and business, you need the full map. You need the models that govern how to deal with risk, how to understand human incentives, and how to identify the subtle psychological traps that derail even the smartest decision-makers. The journey of an intelligent investor is a continuous process of assembling this mental arsenal. Each model you acquire connects to the others, making the entire system stronger and more effective. And the video that is now appearing on your screen is designed to be the next piece of that map. It is the link that connects what you have just learned about business analysis to the deeper principles of decision-making under uncertainty. It is the next essential tool in your intellectual toolkit. This journey is not for everyone. It is for the serious student, the dedicated entrepreneur, the individual committed to a path of continuous learning and rational thought. It is for those who seek not just answers, but a better way of thinking. The choice to click is not about watching another video. It is a declaration of intent. It is the next step in your ascent. Complete your mental arsenal. Continue the journey.